Take a look at this chart. By every traditional metric, the asset shown here is healthy. Earnings reports are strong, public sentiment is bullish, and the headlines are positive. Yet, the price steadily drops. For the average investor, this contradiction is paralyzing. They buy based on a logical story, only to watch their positions get liquidated by an illogical price movement. In the early 1900s, Jesse Livermore discarded the news-based investment strategies of his era. He realized that the narrative behind a stock mattered less than the objective record of its numerical fluctuations. Livermore viewed the market as the collective expression of human psychology. To him, the ticker tape was the only objective record of these behaviors, the raw, unedited print of actual transactions that stripped away all justifications and excuses. To understand how this works, we must rebuild Livermore's framework from the ground up. We will track his evolution from simple microstructure pattern recognition through his strict mechanical rules for risk sizing, and finally into his deconstruction of institutional manipulation. The first requirement of this framework is to ignore the why. If a stock price is collapsing, the reason might not be known for weeks. The reason can wait, but the execution cannot. In a fast-moving market, the only thing that matters is the what of the price. Livermore's methodology did not begin with a study of economics. It started in his teens, working as a quotation board boy. He studied numbers purely as a sequence of behaviors, developing a memory for how certain figures acted before a stock moved significantly up or down. He tested these observations in bucket shops, establishments where retail traders hold bets against the house on price changes. In these shops, patrons never actually bought or sold a real share of stock. This meant their bets had zero impact on the actual market, providing Livermore with a frictionless environment to test his theories. In this environment, Livermore relied strictly on memory. He noticed that specific stocks exhibited parallel behaviors just before major breaks. By logging these fluctuations, he identified repeating patterns where a stock would consistently drop 8 or 10 points after acting a specific way on the tape. When a colleague suggested they buy the railroad stock Burlington based on a dandy tip, Livermore checked his notebook. The data confirmed that Burlington was exhibiting the exact pre-breakout pattern he had tracked. The empirical evidence validated the rumor, which was the only reason he placed the trade. But the bucket shop strategy had a mechanical limit. As this side-by-side comparison shows, trading on a real exchange is not frictionless. Unlike a bucket shop, a large market order on the New York Stock Exchange eats through the bid-ask spread to find enough shares to fill. This creates an execution premium. When your own buying puts the price up and your own selling pushes it down, you are physically forced to pay for liquidity. Livermore realized that the mechanics of the exchange itself act as a tax on every large trade. Pure pattern recognition is worthless if a trader's order size destroys the pattern. Any speculator moving significant capital must account for the mechanical friction and liquidity constraints of the real market. To navigate these constraints, Livermore developed the concept of the line of least resistance. Prices move along a physical path based on whether they encounter less friction from buyers or sellers. The speculator's job is to wait for the moment when that line defines its direction. Look at this historic breakout in wheat. The price repeatedly tests the $1.20 mark, but fails to cross it. Livermore refused to buy early. He waited until the price conclusively broke through $1.20, proving that the upward movement had finally gathered the force to push past the resistance limit. Once a position is established, the same logic applies to the exit. When Livermore held a massive block of Anaconda copper, he didn't wait for a specific price. Seeing demand on the tape, he hit the bid, feeding his shares into the market while there was enough purchasing power to absorb them without crashing the price. Managing these entries and exits requires a strict framework for risk sizing. Livermore established an absolute rule. A speculator must never buy their entire position at once. Instead, he used a probe. If he wanted 50,000 bales, he would initially buy 10,000. This small test order risked a fraction of his capital to physically probe the market's liquidity and confirm the line of least resistance was moving in his favor. He practiced a method called pyramiding, never making a second transaction unless the first probe showed a profit. This forced the market to prove him right before he committed major capital. This empirical testing separates speculation from gambling. By using small test trades, a speculator identifies the market's true liquidity before risking their entire fortune. Even the most pristine models are vulnerable. Rigid systems fail because they map historical correlations that cannot account for sudden human panic or major exogenous shocks. When the unexpected occurs, the geometry of a model shatters. Livermore categorized market failures into a hierarchy. The raw beginner trades blindly, but the second-grade sucker is more dangerous because he has memorized trading rules and technical axioms. He applies them rigidly, ignoring the shifting human dynamics driving the tape. Livermore himself nearly bankrupted himself when he allowed a cotton expert, Percy Thomas, to persuade him with logical supply and demand statistics. Thomas's arguments were so convincing that Livermore ignored his own empirical tape readings and held a losing position. Conversely, the tape can expose false information. When an older operator, known as the Deacon, heard that insiders were quietly buying sugar stock, he checked the tape. The price action showed heavy selling. Realizing the tip was actually creating liquidity for insiders to exit, the Deacon sold short against the public buy orders. As shown in the Thomas and sugar trades, a speculator's greatest risk is often their own psychology. Even accurate technical readings fail when a trader allows personal bias or a persuasive external story to override the objective price action on the tape. Institutional market manipulation operates as a systematic, mechanical exercise in advertising. Its primary function is to generate enough public liquidity to allow an insider to exit a massive position without collapsing the price. This chart illustrates the anatomy of an engineered move. In Phase 1, accumulation, insiders quietly build positions. In Phase 2, the markup, price velocity spikes aggressively. In Phase 3, distribution, volume explodes, but upward price progress stalls completely. The markup phase creates its own momentum. When Livermore manipulated Imperial Steel, he simply bought aggressively to drive the price up. That price velocity forced the financial press to retroactively invent bullish narratives to explain the move, which brought in the public. During distribution, the manipulator unloads shares into the enthusiastic public buying. They may briefly buy back shares on small dips to build false confidence. Once the insider line is sold, the artificial support bids are pulled, and the price drops as the public is left holding the bag. This operation relies on the asymmetry of information. Insiders accumulate silently when they see improving fundamentals, and distribute silently when they see the company's prospects deteriorating. During a decline, corporate directors may release anonymous statements claiming the company is healthy and blaming bear raids for the drop. These bullish statements are designed to prevent the public from selling, creating the necessary exit liquidity for the insiders themselves. Market manipulation is the engineered exploitation of public psychology. By using the tape as a lure, manipulators artificially generate demand to transfer risk away from themselves and onto the public. Success in this environment requires 4 specific tools: accurate observation of the tape, the experience to categorize those observations, the memory to recall past precedents, and the mathematics to manage risk. Market mechanics will continue to change, moving from bucket shop chalkboards to high-frequency algorithms, but the underlying engine, the human nature driving the fear and greed, remains constant. The tape demands immediate action. By the time the fundamental reasons for a price movement are published, the capital has already been made or lost. The explanation can wait, the execution cannot. The tape distills the aggregate actions of millions of participants into a single, undeniable metric. It strips away the qualitative noise and reveals the empirical truth. Surviving the market is not about outsmarting the news. It is the practice of mastering oneself against the unforgiving mathematical reality of